They want these banks to fail. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, these 10 big banks are next to fail as speculators are betting big that these banks won't survive the next crisis. We're going to show you who these 10 banks are and why the next crisis is far worse than the liquidity crisis we just saw. And this is coming at a time when the Fed is saying that there's nothing wrong with the banks and that interest rates will need to stay higher for longer. We're going to show you why the market is betting now that the Fed will cut rates not once, but 3 times this year, and why these policymakers are completely wrong. Plus, we're seeing cracks in the labor market, and the services sector is taking a downturn. Let's over to Bloomberg, where we picked today's story up with a headline. Toronto Dominion becomes the biggest bank short with $3.7 billion on the line. And what I want you to understand here is that speculators are seeing easy prey here in the banking industry, and perhaps there's some very good reason for this. And let's dig in, because again, if you thought the liquidity crisis was bad, and it was, wait till you see what's coming for the banks next, because this time they're not going to make it through, and the Fed can't save them. Part of it has to do with the general skittishness toward the banking sector after 3 U.S. regional banks failed and Credit Suisse was forced into a shotgun wedding with UBS. But analysts also point to worries about TD's exposure to the country's housing slowdown, as well as ties to the U.S. market through its stake in Charles Schwab and a planned regional bank acquisition. So the issue here, when you think about what the challenge is, and we specifically looking at TD here, is it really the issue with Schwab or their coming acquisition? No, it has a lot to do with the housing market, because what was the issue we saw with the banks that failed here recently is they were upside down on their treasury securities. They needed cash and they couldn't get it because they couldn't sell their securities. They had these unrealized losses. Now, I want you to think of if the housing market slows down, and we talked about in yesterday's show the corporate market for buildings and corporate real estate. If that slows down and prices start to fall, guess what we're going to see on these banks' balance sheets is unrealized losses on their loan books. And here the largest short bets in financials are coming from these major hedge funds and investors as they bet big against Toronto Dominion Bank, BNP Paribas, Bank of America, JP Morgan Chase, T. Rowe Price, Citigroup, Mitsubishi, Unicredit, Bank of Nova Scotia, and Blackstone, who we talked about yesterday, and their big problem with their B-REIT fund. So you kind of get an idea of anybody who's holding particularly probably a lot of commercial real estate is going to get targeted here, because any type of these investments that start to flip upside down and you get unrealized losses, again, now you have a double whammy for the bank. You have their investment portfolio, their bond portfolio being upside down, and then you have their loan book being upside down. There only is one eventual choice the Fed will have to make, and it's not a question of how low they'll go. The question is, can they go lower than they did last time? But let's dig deeper into this, as some of these short sellers have targeted TD because of its roughly 10% stake in Charles Schwab, which recently lost $47 billion in market values. It came under scrutiny over its unrealized bond losses. But again, I think that's a drop in the bucket when we see what happens to these banks when their loan books go upside down, as well as TD's position in Canada's housing market, where variable rate mortgages are common and consumer insolvencies are on the rise. And so there's the second side to this, insolvent loan book that I think is issue that's coming, is what happens when the labor market slows down, which we'll talk about later in today's show, and you start to see people hit the unemployment line, they start to run out of money, and next thing you know, they stop making payments on their loans, their assets are upside down, and now the bank's got a huge problem because they can't unload those at loss when they need to unload those assets at a gain, which they won't be able to do. And TD sits uniquely in the middle of two broad headwinds. The fears around Canadian housing will be projected onto them, and I think that's coming for a lot of banks, because now we're seeing the U.S. economy grinds to a halt as loan demand, sales crater in aftermath of banking crisis. Now, this headline from Zero Hedge, because there's a second side to this whole piece. When you think about where new money comes from in the economy and what we need to pay on loans, is you need creation of new money to pay on old debts. And where do you you get new money from? Well, as you know, it doesn't grow on trees, but where it does come from is the origination of new loans. So as long as you have new loans being created by the banking system, then that means new money is created and old loans can be paid on. But what happens if the banks choose to stop lending? Well, that's where you start to fold out to the next crisis. And here you can see from the Senior Loan Officer Opinion Surveyor, SLOOS, reporting tightening standards. Now, we've looked at this before, but one nice thing is Zero Hedge has a chart that goes back all the way to 1990. Notably, the St. Louis Fed, where we get a lot of our charts from, doesn't have data going back that far. And so here you can see they're tightening standards. If we go back and look at times when they did, we can see in 94 there was a soft recession. And you look here going into 2000, we had the dot-com bubble, then we had the great financial crisis. Then we had, of course, the pandemic, and now we're at levels consistent with two major recessions and a pandemic. Of course, we have this little tightening here, which, remember, we almost had a global recession around 2015 going into 2016. And so you can see the banks are lending less. And of course, that means less money is being created in the economy. And here we can see now this data from the St. Louis Fed. We've got the commercial industrial loans for large and mid-market banks, as well as small banks, and they're seeing their tightening standards. So when you see this blue line go above the horizontal black line, it means lending standards are tightening, and I've got that shown against commercial industrial loans on a year-over-year rate of change. So what you would expect to see in this chart is as banks tighten standards, which just simply means you or I go down to the bank and say, we'd like to borrow money. And they say, well, compared to last year, you have a lot more things we need you to do, more collateral, more requirements, more rules. And some people are not going to be able to meet that and not get a loan. That's the whole point of tightening standards, because banks worry about getting their money back when the economy slows. So what should happen is we should see commercial industrial lending start to decelerate and then eventually contract, and then the whole thing blows apart. And sure enough, that's exactly what we see. As banks tighten standards, in red, we have the year-over-year rate of change in commercial industrial loans. You see it starts to slow down here during the dot-com bubble and then starts to head out as the recession unfolds and goes negative. Here you see during the global financial crisis, lending standards tighten, and of course, loan growth slows and goes negative. And now all of a sudden, we're seeing lending standards very tight, loan growth starting to roll over, which is consistent with what we should see. And we can already tell this is headed lower, and that means you've got less new money to pay on loans that are old loans, and that is a problem. And now let's head over to the Dallas Fed, who is backing this up with some recent survey data. As they say, loan demand falls and outlook worsens, a problem for the banks as loan demand declined for the fifth period in a row as bankers in March survey reported worsening banking business activity. Loan volumes fell, largely driven by a sharp contraction in consumer loans. No surprise, consumers can't get loans because banks don't want to. And loan non-performance increased slightly overall, which will get worse when people start losing their job, with the only notable rise in the past 6 weeks coming from consumer lending. Credit standards and terms continue to tighten sharply. Again, we see this being a problem as banking outlook continues to deteriorate, with contracts expecting a contraction in loan demand and business activity and an increase in non-performing loans over the next 6 months. So you see exactly how this shapes out. Banks start tightening lending standards, they start issuing fewer loans, there's less new money being created, and the next thing you know, they start to get worried about how people are going to pay on their loans. It's simply because there's not enough money in the economy to pay on all the debts. So you need this constant creation of new money from the banking industry, who's only making it worse. And then we look at the money supply. So you start to see there's two factors here in this next crisis. It's the first one is that banks aren't out there lending enough to create money to pay on the loans. At the same time, we're losing money disappear in the monetary system. And here we see the M2. Now, this chart going back as far as the Fed database has, as we like to usually look at, and what do we see? It is negative. This is something that hasn't happened in my lifetime, and probably not many of yours either, of course. And based on this data, it goes back further. The contractions in the money supply are extremely rare. So this means, that liquidity crisis we talked about in the banks, where is all this money going? Well, if you don't have enough new money created to pay on old loans, think about this. What happens is money is going to still has to be paid on these loans, but there's not enough new money being created into the money supply. And next thing you know, you have a contraction, you have repeated liquidity crisis at banks, you're going to have layoffs, you're going to have insolvencies, you're going to have upside down loan books, you're going to have major problems. And so the question a lot of investors are asking is, well, is this a time to invest in the banks? Well, perhaps not, but if you're looking for an opportunity, we look at our CTA-Timer Pro report. It caught that recent move in XLF, and all you have to do is for $30 a month, it tells you how the machines would look at the market here on these ETFs with a historical weighting, but you can see it remains on the longer scale, a slower scale, 100% short, as does the regional banks. Here you see 100% short across the board. And again, I'm going to be raising the price pretty soon. Jump on board, try it out, 30-day risk-free trial. There's videos explaining how to use it. If you want to know when a trend reversal is coming, you'll see that report will give you the lead. But one place that doesn't have the lead on things, well, that's the Fed, who keeps claiming that everything's okay and that rates will need to stay higher for longer, but that's not going to happen. As Fed's Metre says, rates should rise about 5% and stay there for some time. And yet this comes at a time when the federal funds futures, which I don't have the chart for you, is pricing in not one rate cut this year, not two rate cut this year, but three. So the question is, as we go through this, I want you to see how the Fed is viewing things, and the market is telling us that no, they've got it completely wrong. In fact, something's going to happen that's going to force them to cut rates 3 times. I'll let you weigh in the comments. What do you think it is? Recession, financial crisis, inflation coming down? What do you think? And now let's take a look. To put inflation on a steady path down to 2%, monetary policy needs to move somewhat further into restrictive territory this year, she says, when the Fed funds rate is moving above 5% and the real Fed funds rate stays in positive territory. In a question and answer session, she said that so far it seems to have stabilized, referring to the banking sector at the moment, pointing to actions by the Fed and other regulators to stem the contagion. She said she also doesn't anticipate that policymakers will cut rates this year, but yet when we look at this is a 10-year 3-month yield curve in blue, shown inverted, with the inversion now above the horizontal black line against the federal funds rate. So when you see the 310 steepen, again shown inverted, it means the Fed is going to be cutting rates. So this deep of an inversion, extremely rare, suggests that as soon as it starts to steepen, that the Fed is going to be on the wrong side of this market and need to cut rates. And that's why you're starting to see the bond market, the Fed funds futures, start to price in that the Fed's got this completely wrong. Precisely how much higher, she says, the Fed funds rate will need to go from here and how long policy will need to remain restrictive will depend on how much inflation and inflation expectations are moving down. And that will depend on how much demand is slowing. Well, it's coming down in a big way because we know inflation expectations are largely a function of all gas prices. And when shown on a year-over-year rate of change against the consumer price index in red, we can note that inflation is indeed going to come down in the months to come. But what about this as we look to the labor market today, getting the ADP report missing expectations of 200,000 jobs created, shows 154,000 in March. Notable from their chief economist saying the payroll data out of March is one of several signals that the economy is slowing as employers are pulling back from a year of strong hiring and pay growth, and the 3-month plateau is itching down. And look at where this is coming out of. We talked about the ISM manufacturing. We talked about how it was showing that payroll employment should be decreasing. What do we see here from ADP in March? 30,000 manufacturing jobs lost. We still note the services sector is booming. Now the question will be, though, is for how much longer? Well, let's take a look at the ISM services data that dropped today, because this sector was supposed to continue to drive the economy into the summer months, and now we're seeing a huge problem as it's slowing down. What do we note? The services PMI came in at 51.2, down from 55, showing that it's still growing, but just at a very slow pace now. Notably, look at this. New orders went from a very hot and strong 62 down to barely growing at 52.2. Employment 54 down to barely growing at 51. So again, you're seeing this employment issue first showing up in the manufacturing, now showing up in a slowdown in the services, which should follow the manufacturing sector by about 2 months. Look at the backlog of orders. Again, we talked about that in yesterday's show, down 48.5, starting to contract as the services sector gets caught up a little bit, and inventory sentiment is rising, suggesting that things aren't moving off the shelves in the services sector as we thought. So all this is putting up some pressure against the banks. It starts to make sense why hedge funds and speculators are betting on a collapse, because the next crisis, we're seeing it forming right now. And we've said before that when the labor market goes, all bets are off, and we're starting to see it happen. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.